Please ask him what impact does the zero interest rate environment across places like Japan and Europe have on their banks, whether the business is still good, and does the prolonged low interest rate regime in the United States hurt the prospects of American banks like JP Morgan, et cetera? And in such circumstances, do Indian banks, which have high return on equity, look attractive?
स्टॉक मार्केट रिलेटेड इंटरव्यू वीडियो पाने के लिए मेरे चैनल को सब्सक्राइब करें और बेल आइकन को दबा दें।
There's been a lot of speculation. In fact, some of the questions that came in over this weekend were questions about those airlines, wondering if you would buy any of them outright. Have you considered buying any of those companies outright?
It'd be very unlikely we would do that. I'm not saying it's impossible, but it's complicated.
Why?
Well, for one thing, they're regulated, and there's an interplay. I'll just give you an example, not that we'd be doing, but with Delta, we own 18% of American Express, and American Express is a bank holding company, and bank holding companies have limits as to what they can do, and we're a passive holder of a bank holding company with American Express. But then if we owned an airline that was tied up with them, they'd have lots of arrangements. There's a lot of complications because it's a regulated industry. Anytime you get in a regulated industry, you have more complications in transactions.
So is it fair to say you like these stocks and you would own more if it wasn't complicated?
Well, to go beyond 15% in any company, we would have to go in on Hart-Scott-Rodino. I mean, there's a lot of rules as you increase your ownership. Obviously, almost anything we own, we'd like to own more of.
Are you buying more of any of those stakes right now? Apple shares?
Right. I get pretty close-mouthed when it comes to what we're buying.
You thought about that for a second.
I feel my jaws lock up.
But fair to say,
it's fair to say that anything that we own, we like. There's very few stocks that we own, and I look at them as part ownerships in businesses. There's very few that are selling at some price where I would sell them a little higher.
All right. Well, let me ask a question that came from Tony Dickinson. He said, in the fourth quarter, Berkshire sold 55 million shares of Wells Fargo. Should shareholders view this as a lack of confidence in the new CEO turnaround plan? And what is Warren's future outlook for Wells Fargo?
Well, I won't give him any advice specifically on Wells Fargo, but it's absolutely true that we've sold down our position. Some of it was sold down to avoid being over 10%, because then you do have some filings with the Fed and so on. But
They've sold well more than that.
Yeah, we've sold well more than that.
I think 8.4% was the last.
Yeah, that sounds right. And no, we sold Wells Fargo in the fourth quarter, and we sold it earlier.
Can I ask why? Only because I did get a number of questions.
Yeah, well, I can understand that, but we just don't want to give any advice on what we're doing, because I could change what I'm doing tomorrow. We talk about everything except we don't give stock advice.
Okay. I'll try one more from Tony Dickinson, just because I think I got 15 or 20 different questions on this. Berkshire owns $32.58 billion of Bank of America and $17.39 billion of Wells Fargo. One position's been increasing while the other's been decreasing. Does Warren like Bank of America twice as much as Wells Fargo? And how should shareholders view the holdings?
Yeah, well, I think they've seen that we bought Bank of America and we've sold some Wells Fargo.
All right, let me ask you a broader question that comes in just on interest rates and the impact that might have as well. Varun Jain writes in on Facebook, hi, I'm a huge fan and a student of Mr. Buffett. Please ask him what impact does the zero interest rate environment across places like Japan and Europe have on their banks, whether the business is still good, and does the prolonged low interest rate regime in the United States hurt the prospects of American banks like JP Morgan, et cetera? And in such circumstances, do Indian banks, which have high return on equity, look attractive to Mr. Buffett?
Yeah, well, I can't comment on that latter, but generally speaking, with there are a lot of other variables too, but the banks are going to make more money if there are higher rates with a steeper curve. The curve is more important. In other words, the 10-year versus short-term rates may make more difference in the absolute level. But American banks have made very good money with very low interest rates. Around the world, if you look in the UK or Europe, or Japan, even lower rates have made it pretty tough for banks. The returns on equity are not as high, and they have to use more leverage to even get the same returns, and I don't like that as well.
If you are talking about the curve that we're looking at this morning, the 5-year, 2-year is inverted. 2-year 10 is not right now, but the 10-year is below 1.4% this morning.
And think about it, the 10-year at 1.4%. That means you're paying 70 times earnings for something that can't increase its earnings for 10 years.
Okay,
now, somebody came to you with a stock and said, you know, this is a terrific stock. It sells at 70 times earnings. The earnings can't go up for 10 years. You'd say, well, explain that to me again.
Right.
But no, we've never seen a situation like this in the world, literally. I mean, you can go back and read Keynes, and you can read Adam Smith, and you can read, all the great ones. And they don't talk about negative interest rate. It never crossed their mind. With supply and demand, all these marginal costs. But brilliant economists never really anticipated that you would have negative. You've got 13 trillion or something like that worldwide at negative interest rates, and we don't know what that means. We've got a lot of people who can speculate what it means, but 10 years from now or 15 years from now, we'll look back and say, well, it's obvious what would happen under that, and we'll see it. But it is not a normal situation, and well, interest rates are the basis of all value. I mean, if you knew interest rates were going to be zero for 100 years, you would think 1% was a great rate of return. But you also would know if you bought something that was yielding 1%, or that was what it paid, and rates went to 8%, you'd lose practically all your capital. So it's an enormous factor, and we don't know the answer. Central banks don't know the answer. All we know is that it's been useful in stimulating things, and particularly asset prices, now for 10 years. And what we thought was temporary in 2008 and 9 in the way of monetary policy to stimulate, we've just put our foot on the gas even further. The whole world has.
You made a point in the letter of saying that you don't know how long these interest rates will last. Right. You and Charlie never try and figure these things out. But we did have St. Louis Fed President Jim Bullard on the program last week, and he said that he expects to see these low interest rates for a long time to come. That does raise a lot of questions, if that happens, about what this means for the stock market, what that means for banks, what that means for insurance companies, which you touched on in the letter, too. It's
bad for insurance companies, but it's good for stocks.
Bad for insurance companies, and what happens to the insurance companies as a result? Are they getting more?
Well, it depends.
Some insurance companies kind of pushing out risk.
The ones that really get hurt on it are either life or annuity companies that have promised returns. The property casualty business doesn't promise returns. It still holds money, so it hurts them. But if you promise somebody an annuity that's going to pay them 3 or 4%, and now you find that you're reinvesting your money at 1% or something, you're going to disappear.
Are insurance companies being forced to make riskier and riskier bets?
Well, they shouldn't be. I mean, the answer, if you need to get 3% and you're only getting 1%, the answer is to quit giving 3%. It's not to try and get the 1 up to 3 and do more dangerous things. You should always adapt your consumption to your income. You shouldn't try and adjust your income to your consumption. That's a basic principle for individuals, businesses, and everything else. And reaching for yield is really stupid, but it's very human. I mean, and I understand it. And people say, well, I've saved all this money all my life, and now I can only get 1% out. What do I do? And the answer is you learn to live on 1%, unfortunately. And you don't go and listen to some salesman come along and tell you, I've got some magic way to get you 5%.
Do you think, though, that's what should be happening? Do you think that there is more risk taking place in the insurance market as a result?
And you see that in what they call leveraged loans and weaker covenants. No, people are reaching for yield. There's no question about that, and that's stupid. And it has consequences over time. But it's very human.
Consequences that could have a big market impact?
Depends how far it goes. Yeah. It's something that the things that get built in slowly, people going crazy in tech companies in the late 1990s, it can take a lot longer than you think. Mm-hmm. but eventually you get to midnight and everything turns to pumpkins and mice.
You know, that's the downside of
Yeah.
low interest rates, pensions, savers, anybody who gets left in a raw position of that. On the alternate side of things, if rates were to rise rapidly, or maybe not even so rapidly, what does that mean for the federal debt?
Well, it depends on the average maturity of the debt, but our maturities are fairly short. They've gotten lengthened a little. But if you take 20 trillion and you're borrowing at 2%, you've got 400. What have you got? 2 trillion to 200 billion. You got 40 billion of the expense, but if it goes to 5%, you got 100 billion of expense. I mean, no, at 5%, you got a trillion of expense. I'm sorry. It's we are benefiting enormously in our national budget by the fact that interest rates are very low, and so interest cost has not gone up as you would have anticipated if you were looking at the scene 20 or 30 years ago with the increase in national debt. Austria issued 100-year bonds, at 2% or thereabouts, and then they've gone way, way up. And I think maybe they yield 1.1 or something like that. I don't know where they are now. But it's great if you're a borrower to have cheap money. I mean, everybody should refinance their mortgage.
Is that an argument for the Federal Reserve, or I'm sorry, for the Treasury Department here, issuing longer notes?
Well, yeah, but I would have said the same thing 5 or 6 years ago and been wrong. But if we, under the present slope, it still would cost more to lengthen it out. But you're lengthening it out at very, very low rates. And it would be what I would be inclined to do if I were Secretary of Treasury. But I'd have missed a lot of bets in the last 10 years, too.
Warren, again, for people who are just waking
Sure.
up, they're tuning in and they want to know what you think about this sell-off this morning. To see the Dow down 700, 800 points in the morning,
Yeah.
What's your reaction when you see something like that?
Well, my reaction is that I like to buy stocks, so I don't wish ill on anybody else, but I like to, if they want to sell them to me cheaper, I prefer it. So if that's roughly a 3% decline or thereabouts, I don't know how many 3% declines I've had in my lifetime, but there have been a lot of them. And I can't think of one that you shouldn't have bought on, basically. That doesn't mean stocks are going to go up or down next week or next month or next year. But if there's something, if you like to own American businesses, you're getting a chance to buy it 3% cheaper. I don't consider that a lot cheaper. I mean, but how can it be bad news unless you have to sell stocks? Now, if you have to sell them for some reason, you're worse off. If you don't have to sell them, I mean, somebody can come around and offer you a quote on your house today, and it can be 2% less than they offered you yesterday. But if you like the house, it really doesn't make any difference to you.
Does that mean Berkshire will be buying stocks today?
Well, we certainly won't be selling, and yeah, we could easily be buying something, sure.
Okay. Let's talk a little bit about a Barron's cover story that was just out last week. The good news on the cover story is they think the Berkshire is worth more than it's selling for right now. The bad news is they said they think that's in part because it's got a big conglomerate discount, and they think if you weren't running it, that it might get broken up. What's your response to that line of logic?
Well, conglomerates have had a bad name, and for good reason, over the years. I mean, I closed my partnership up at the end of the 1960s, and there was a very abusive run in conglomerates where they played with numbers and they had dirty pooling, as they called it, of accounting. They wanted to have their stocks up and put out stories to do it so they could issue more stock. They were kind of chain letter arrangements. There've been a lot of bad conglomerates, and probably disproportionately so compared to sort of honest-to-God single industry businesses over time. We don't think we're that kind of a conglomerate. We've certainly never wanted to issue shares. We've never touted shares. And it's done for business reasons in our case. The interesting thing is, of course, is the American public has been going wild in their enthusiasm for conglomerates in the last few years, if you think about it. I mean, it's been an incredibly popular area. But they call them index funds. Oh. You buy 500 businesses.
Trying to figure out what you were talking about.
Yeah, well, 500 businesses all put together. I mean, that's the ultimate conglomerate, isn't it? I mean, I've recommended index funds to lots of people, and when they do it, they're buying into 500 businesses. And they're going to have 500 businesses a year from now and 5 years from now, and they think that group of businesses that will do very well. And I think our group of businesses will do okay.
The difference with an S&P 500 index is it's 500 different companies run by 500 different management teams who are all focused on their business, maybe not having a centralized operation that is loosely running all of those businesses.
Well, our businesses are run by separate people. I mean, we just finished Valentine's Day, and I did not select what pieces went in the boxes. and it's probably been 10 years at least since I've been to a See's Candy factory. Now, I get the figures every month, but I don't know how to make chocolate, anything of the sort. I don't pick out the new locations. We have managers for our businesses that are very much like the managers we have for the businesses that we own pieces of, like American Express or Coca-Cola. And there's a couple things we can do. We can determine the dividend policy of our subsidiaries. Mm-hmm. We can control their capital allocation to some extent, but on most capital allocation, whether to buy new equipment or anything like that, they make the decision. The BNSF Railroad is going to spend $3.5 billion on. I don't approve a single dollar of that in terms of capital expenditures. They know what they need to do, where they need to lay track, how many locomotives they need, whatever it may be. So our managers are, I would say, in a sense, they're almost more independent than the managers of the S&P 500 who go around and report to Wall Street week after week. They go to investor relations meeting, and they're always explaining what they're doing and trying to get the approval of the analysts and all that sort of thing. And we just tell our managers to do what makes sense.
Okay, outside of the idea of them not having to report to individual shareholders or the investment community, what's the advantage of having you there? The capital allocation part of it?
Well, we can move capital within. If you move capital from one stock to another, and you got a gain, particularly, I mean, you pay a tax, and may pay a dividend tax, or if you sell, but there's a lot of taxes incurred in moving from one business to another, either at the corporate level, in some cases, but certainly at the individual level. And we can move capital. Well, just take See's Candy again. We bought that in 1972. We've moved several $1 billion from the candy business to other types of businesses. And we'd love it if we could use it all in the candy business, but it just isn't that sort of business. And in addition to that, we free up our managers from all dealing with Wall Street, dealing with bankers, dealing with all kinds of things that are what I regard as less productive use of their time.
However, you also have a situation where you have gotten some activists who have been interested in the stock, including Bill Ackman. He's built up a stake, hasn't said too much about it, but I think he has made some comments about how maybe Burlington Northern Santa Fe's margins could be improved. You can look back at Bill Ackman's experience with the Canadian Pacific Railway and kind of wonder if he is building up a position because he would like to see you take a more active role there.
Well, we notice what other railroads earn and when their margins are better. I mean, and we certainly put way less pressure on than Wall Street might, who would want it next week. But our managers are well aware of what's going on in other industries, and we've made changes where we don't think some businesses are performing as well as they should. But overwhelmingly, we've got managers there that are very, very good. They've got capital available to them for anything that makes sense. And we decide how much they distribute, where the capital moves, and sometimes it moves from one industry to another. And in certain industries, a consolidated tax position really is very helpful to us.
There's a viewer question that came in from Ben Compston, and he asks, it was recently pointed out by Bill Ackman that some subsidiaries like Geico, BNSF, lag their peers in some areas. Would you agree with that? And how can your successor push improvement in subsidiaries while maintaining a decentralized management structure? Well,
at Geico, we bought control in 1995. We had about 2.5% of the market for auto insurance, and we're at about 13.7% of the market. So we've gone from $2.5 billion of premium volume or thereabouts to $35 billion of premium volume. We're number 2 now to State Farm. We were number 6 or 7 at that time. So I would say that not due to Berkshire at all, but due to Tony Nicely during almost all those years. Geico's been the envy of every other company in the auto insurance business, except for Progressive, but they've done a good job too. But Geico is worth tens and tens and tens of billions more than when we bought it, in addition to all the earnings we've given, just the goodwill value. So that's been extraordinarily well run. And with Burlington, I think we paid a dividend of $5 billion last year, and we paid $35 billion for it. So it's gained in market share in its business. Its operating margins have improved, but they haven't improved as much as some other railroads.
Do you believe in precision scheduling railroading?
Well, we'll see. I mean, we've watched it plenty, and
for those who don't know what that is, it's something that kind of irritates customers because it makes things a little more rigid, but it does improve.
Yeah, it makes the customers adapt to the railroad more than the railroad adapting to the customers. And practically everybody's done it. And a fellow named Hunter Harrison was enormously successful.
Who worked with Bill Ackman at the Canadian Pacific.
Yeah, he worked with the BNSF, if you go back far enough. And there's a book about him. It's very interesting. But he did it at the Illinois Central, the Canadian National, the Canadian Pacific, and then he was going over to the CSX. He developed a method of railroading where the customer does adapt more to the railroad, and it improved margins dramatically. Our margins are close to what the better railroads, well, there's only a few, get from precision railroading. On the other hand, we've gained share.
Because the customers don't like it.
Because the railroads apparently, or the railroad customers like us better. And over the long term, we'll see. But it isn't like it's something we can't do.